Lisa Mateo, thank you so much. You know, folks, I'm not big on the parlor game. I really don't care about 4 rate cuts, 8 rate cuts, bada bee, bada ba. But what I do know is it's a lonely crew saying the consensus is wrong. I'm going to put Lindsay Piegza at Stiefel in that group, and the leadership of Jim Bianco has been profound. He absolutely nailed the challenge of the last mile of disinflation. He joins us now from his Chicago. Jim, your note is just piercing. You don't see a Fed cutting soon. Discuss.
Yes, I don't think the Fed should be cutting soon because I don't think that the economic data is supporting a Fed rate cut. And that is that the slowing that you've seen in the U.S. economy might have already bottomed. It is growing at somewhere at around 2.5% for the second quarter. That's fine. And I think that the inflation rate, while it's come down, has largely been in a 3 to 4% range for the last year and a half. It's back to 3%, the lower end of the range. And to use a fancy term, there's some residual seasonality in the data, meaning that you get all the weak inflation data in the summer. And that's what got you down to 3%. And then as we move into the fall, I think it stiffens up a little bit. So the Fed shouldn't cut. But it looks like they're intent on cutting. So
okay, but Jim, your note is inflammatory. I mean, it's really something. You've got, for the sake of discussion, an R-starred set, and we're not talking 2.x%. We're not talking Richard Clarida. We're talking a Jim Bianco 3 or 4, and you even print the number 5. Is America ready for a 3%, 4% R-starred?
America's ready for it because the economy can handle it. The financial markets can handle it. It's the economic community that's not ready for it right now. If you look at the current level of interest rates and you listen to Fed speak, they talk about it being highly restrictive. It might be retarding the economic growth. And again, look at the stock market. Look at the rally in small cap stocks when we started pricing in September in the last week or so. And the data is just not there. But the economists still cling to this, that the neutral funds rate, which is what R-star is 2.5%. And put this in terms, the Fed thinks they need to cut 10 times to get to neutral. That's why they want to get started. They got a lot of work to do. The market is probably telling them, no, you probably need only about 4 or 5 cuts to get to neutral. There really isn't any hurry. But if you're going to give me stimulative interest rates by lowering them, then I'm going to pile into small cap stocks, and that's what we've seen in the last week.
And Paul, on YouTube live chat, they nail it. It's a Sweeney live chat. 6% cash.
Yeah,
I mean that's maybe what Jim's talking
about. What's wrong with that? Hey, Jim, we have seen that rotation into small caps. What do you make of that? Because I mean, what I'm hearing from some of the strategists is that's a rotation like we've never seen before.
Oh, yeah, I agree. I mean, I've looked at the statistics, and it is unprecedented depending on how you look at it. And usually when you get a massive rotation into small cap stocks in the past, it's because the market is literally collapsing, and big cap stocks are going down faster than small cap stocks. This one is everything's going up, except for yesterday, and small cap stocks are going up a lot more. But I really think what it is that this is such a macro-dependent market, and that negative 0.1 on CPI, you know, the bell went off. That's it. The Fed's going to give us cheaper money. Let's go to all of the lagging companies, and let's go to all the companies that have borrowed more, and that would be in the small cap space, or have losses in the small cap space, and that cheaper money will benefit them. So everybody started to exit large cap and ran into small cap to a degree we've never seen before. So there is no historical precedent for what this means, like what does this mean a month or 2 months later, because we've never seen it, especially in a rally.
So this is an election year, Jim. How does that impact the Fed really at the end of the day?
Well, it should, and it has in the past. And to be very nuanced about it, the Fed has never changed direction between Memorial Day and Election Day. Changed direction. If they were hiking, they continue to hike. Cutting, continue to cut. Hold, they continue to hold. They're talking about changing directions in September by cutting rates. That is unusual, and the fear is that interjects themselves into the political debate because Donald Trump won't be happy. He'll say that Jay Powell's trying to rig the election against him. And then the Fed would prefer that their name not get mentioned between now and Election Day. And so they shouldn't be part of it. Now, what does it mean for markets? At a macro level, stocks, bonds, the dollar, I don't think you could really see the machinations in the election there. But when you go further down the line, if you look at maybe the meme stock of Donald DJT, Trump media, that one goes up and down. Tesla seems to be another stock because Elon Musk is so tied himself with Donald Trump. If you look at maybe the prison stocks or the body armor stocks, because there's going to be more spending on police and protection, those kind of things are moving, but not at the higher levels. Are you really seeing this election impacting the market?
Jim, what's the stock market do here? I mean, away from the economics and all, do you have an SPX or Dow Jones faith out 12 months?
Well, the stock market, I think, is going to really take its cues from interest rates. It bottomed in September of 2022, and it's been rallying. And there's only been 2 times when it didn't rally. A 10% correction between June and October of last year, and March and April this year, a 6% correction. What existed during both those corrections? The 10-year yield above 4.5%. When the 10-year yield gets above 4.5%, the stock market seems to struggle. We're at 4.18 right now, so we're not above 4.5%. But if the market starts to feel like the Fed's going to ease, the economy's okay, this inflation problem is not solved, the rejection of that policy could be higher interest rates. And if it gets above 4.5%, that could become a problem for the stock market. Mm-hmm. So right now, I think it's going to be okay. It's just going to go through this massive rotation that we haven't seen before. And it's going to be really dependent on whether or not interest rates start to head higher. Right. And I'll conclude by saying, I ultimately think by the end of the year into the first quarter, they will get well above 4.5% again, and it will be a problem. But they're not there right now.
Jim Bianco from Chicago. Thank you so much, Bianco. Research, really important comments there, pushing against the Fed zeitgeist, to say the least.